On August 27, 2025, global headlines were dominated by the United States' dramatic escalation in trade tensions with India. In a move that stunned markets and policymakers alike, the U.S. imposed steep 50% tariffs on a range of key Indian exports, doubling the previous duties that stood at 25%. This decision targets sectors integral to India's export economy: textiles, gems and jewellery, leather goods, seafood, and furniture. Industries that employ millions and contribute substantially to India's GDP. The immediate aftermath reverberated fiercely through financial markets, business circles, and diplomatic corridors, raising pressing questions about the future of India-US economic ties and the resilience of India's growth story. The backdrop to these tariffs is complex and steeped in geopolitical strategy. For months, U.S. officials have voiced growing concern over India's continued purchases of discounted Russian oil, a move seen as undermining U.S. national security and foreign policy interests. Despite mounting diplomatic pressure, India maintained its energy imports from Russia, citing economic necessity and energy security. The U.S., viewing this as a direct challenge to its sanctions regime and global standing, opted for a forceful response, raising tariffs to unprecedented levels on Indian goods. This escalation marks one of the most significant trade actions in recent years, signaling a shift in U.S. policy and a willingness to leverage economic tools to compel strategic alignment. The impact on Indian exports was immediate and severe. According to recent estimates, these tariffs threaten to reduce India's GDP growth by 0.4 to 0.8 percentage points annually, a significant blow for an economy that has been one of the world's fastest growing in recent years. Exporters in the affected sectors face collapsing profit margins, with potential export losses projected between $25 billion and $55 billion over the coming year. For industries like textiles and gems and jewellery, which rely heavily on the U.S. market, the sudden spike in costs has led to cancelled orders, renegotiated contracts, and mounting uncertainty. Seafood exporters, already grappling with global logistic challenges, now find themselves squeezed by tariffs that make their products less competitive abroad. The shockwaves extended swiftly to financial markets. The Sensex and Nifty, India's leading stock indices, both dropped by approximately 1% in the immediate aftermath, reflecting deep investor anxiety. Sectoral indices linked to the affected industries saw sharper declines, with textiles, leather, and export-oriented manufacturing stocks among the hardest hit. The Indian rupee also came under pressure, weakening against the U.S. dollar as foreign investors reassessed their exposure to the country. While most sectors felt the pinch, FMCG stocks managed to buck the trend, insulated by their domestic focus and relatively limited exposure to export tariffs. Investor sentiment has taken a distinct turn for the worse. Market participants, already wary of global uncertainties, now face a direct challenge to India's export-led growth model. The prospect of reduced earnings, job losses, and supply chain disruptions has led to widespread risk aversion. Many analysts warn that prolonged uncertainty could trigger a broader correction in Indian equities, especially if trade tensions escalate further or spread to additional sectors. For India's vast workforce in export industries, the risk of layoffs and wage cuts looms large, adding a human dimension to the economic fallout. In response to this crisis, the Indian government has moved quickly to reassure businesses and investors. Officials have pledged to protect key domestic sectors and are rolling out a series of relief measures aimed at cushioning the blow. Among the steps under consideration are cuts to the Goods and Services Tax, GST, for affected industries, favorable loan incentives for exporters, and fast-track approvals for exporters seeking to diversify into new markets. There is particular emphasis on expanding trade with regions less exposed to U.S. tariffs, such as Latin America, Africa, Southeast Asia, and the European Union. Negotiations with these partners have been accelerated, with the hope that new export channels can offset losses from the American market. However, these measures, while welcome, may not be enough to fully compensate for the immediate disruption. Analysts caution that unless India can swiftly reorient its export strategy and address supply chain vulnerabilities, the risk of prolonged market turbulence remains high. Job losses in textiles, leather, and jewellery are already being reported, and smaller exporters, lacking the resources to pivot quickly, face existential threats. There is also concern that the tariffs could trigger a broader realignment in India's foreign policy, pushing New Delhi closer to China and Russia at a time when global alliances are in flux. Looking to the long term, the outlook for the Indian economy hinges on several key factors. First, the effectiveness of government interventions will be crucial. If relief measures succeed in stabilizing affected sectors and supporting job creation, the worst economic impacts may be averted. Second, the ability of Indian exporters to adapt by upgrading product quality, tapping new markets, and embracing innovation will determine whether India can sustain its export momentum. Third, the trajectory of diplomatic relations with the U.S. will shape future trade policy, with the potential for either reconciliation or further escalation. There are also broader lessons to be drawn from this episode. The events of August 2025 underscore the vulnerability of export-dependent economies to geopolitical shocks and the importance of diversification, not just in products and markets, but also in supply chains and technology. For India, the challenge is to build greater resilience, invest in domestic manufacturing, and cultivate a broader base of trading partners. The government's renewed focus on market diversification and industry support signals a recognition of these imperatives, but implementation will require sustained effort and strategic vision. As the dust begins to settle, the question remains: will India withstand the tariff shock and emerge stronger? Or will prolonged market turbulence undermine its growth prospects? The answer will depend on the agility of policymakers, the adaptability of businesses, and the evolving dynamics of global trade. For now, investors, exporters, and workers alike are watching closely, hoping for stability amid uncertainty. What's clear is that the stakes have rarely been higher. The coming months will be a critical test of India's economic resilience, its diplomatic acumen, and its capacity for innovation in the face of adversity. As new policies roll out and exporters seek fresh opportunities, the world will be watching to see whether India can turn this challenge into a catalyst for long-term transformation.